AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines. You always start off wrong. Welcome back. We assume that everybody that's here today was here last week. Welcome back.
Assume. And welcome in if you are new. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report. We are your second opinion for real estate and mortgages. We've got about 30 years combined in the business. Gordon's been a real estate expert and practices what he preaches. He's done everything from resales, a lot of people know them as flips, to real estate brokerage, to a mortgage brokerage, to property management. I've been in financing for over 18 years. I've been in real estate for the last 15 years. Myself doing very well. And we like to give your opinion. We also enjoy questions and emails. You can email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com, or call the show, 800-516-1220, 800-516-1220 as promised. We're going to talk about several topics today. The new mortgage loan limits, Gordon. This is kind of, to us, it's exciting. It's like, not a lot of things change for the positive. This is one of them.
No. I'm excited. 2018 is going to be another blastful year, I'm calling it. Prices are going up, so conversely, mortgage limits have done the right thing and have gone up accordingly. Didn't quite go up as much as I would like to see them go up, but they are gone.
Combined, though, from the last two moves, they've added up. Right now, we'll talk about it right now. $453,100 for your conforming limit. That used to be $417. That's $453 now.
No, it used to be $424,100.
Well, it used to be $424, but we started at $417. So I'm trying to show a little bit more positive.
Okay.
Instead of that 6.9% increase. $679,000 for what they call your high balance conforming. We'll get into this and what are some of the reasons why this actually means and what it means to you and why it makes sense. We want to talk about adjustable rate mortgage. We skipped a couple of weeks on that, why they're making a comeback. Gordon, I know you're like, second home strategies that people can use to buy. We have some very interesting news from some lender updates on second homes and some of the mortgages you can use for that.
We also got a couple of clients we're doing second home loans for.
You know, the email came from Scott. Okay, this was a great email, and he's talking about second homes. We just kind of hit on this right now. He's got a property in San Francisco. It's a condo. He doesn't have parking. He doesn't have off-street parking. It's a 2-bedroom, 1 bath. Him and his wife live in there. He doesn't have any kids, but he's got a lot of family. And he said basically, I can't ever have a Christmas at my house. I can't ever have a Thanksgiving or a holiday or any kind of event, and I don't have a yard for hobbies. I can't store a car or anything like that. So he went and bought a second home in Sacramento. And I think this is great. And he wants to use this as his home base or a base of operations where he goes there and he can store a car and he can do gardening with him and his wife and then have those family events. And they go, okay, guess what? Let's all saddle up. We're all ready to go skiing, and they go hiking or skiing or biking and all the things that he likes outdoors. And he's so close now to, Route 50 and 80, depending on what side of Tahoe he wants to go on, or the mountains, and fishing's out there too. I think this is a strategy a lot of people are using or nowadays, and getting that getaway house, finding that it's just you're bumping elbows here in the Bay Area, and this is the next step to California real estate for a lot of people.
Well, it's interesting because traditionally when we talk second home, we talk resort area, we talk beach, we talk mountains, we talk resort. But it's interesting that a guy living in San Francisco, who by the way, who loves living in the city, loves all the benefits of living in the city, walk into the grocery store to cot, even though you have to deal with no parking, that kind of stuff. He loves the city, but also he can now get the diverse weather by moving to Sacramento, which is traditionally not a resort area, but it does qualify for the second because it does pass the test and it does make economic sense, and that's why we were able to do that transaction for him.
So it's a true second home, and a lot of people ask us what are some of the criteria to be considered a second home, and it has to pass that test, Gordon. Talk about some of the things that it has to pass.
Well, the biggest test, of course, is distance. It's got to make sense. A lender's not going to do a second home for a house around the corner where you're going to sleep in one house one night, sleep in the house the next night because it's in walking distance. The biggest distance has been the second home test. One of the tests that was modified was the resort test. They had wanted to be in the Big Bear, over in
or the Tahoes
Tahoe
or
area
wine country or
yeah.
beach country. Yeah.
And they've kind of remodeled that now because of the economics of life have actually changed. People now are doing a lot of different things. That affordability factor is a difference because maybe he could not afford a second home in the Tahoe area or the Big Bear or something, but he can't afford a second home in Sacramento because of the lower price market.
One of our lenders just came out and said that they're doing jumbo loans up to $1 million on second homes, which I think is fantastic because right now, a lot of 90-something% of the lenders that you walk into or online are going to say we're cut off on a second home up to $679,000 now.
Wow.
Now you're up to $1 million with some of these lenders to 80% LTV, which means 20% down on a second home up to $1 million. So that is fantastic that they are doing that. Some of the strategies, I think that's one of the strategies that I would do of a second home. For example, let's say I go on vacation, I'm spending $20,000 a year on vacation. And I know people who do that. The Hawaiis, the Cabos, could be LA, could be anywhere. Or they buy a second home somewhere and they use that as kind of their home base to do the activities that they need. So you take $20,000 divided by 12 months. I think you come out to $18,300 a month. So you can start thinking, okay, maybe I'm spending that much toward vacation. Why can't I just go to a house that I own and I can build some equity, make the payments, and then have that home base and build it as a really great place that's furnished and you can store that car or have that decor in there that you want. Who knows? I think these are the way people are starting to think. It could be a wine country. It could be a wine decor. Or it could be in the beach. It could be surfing decor. Who knows?
Well, the biggest challenge with a second home, of course, you have to qualify with two mortgages. Typically, there's no rents that are actually assigned to that property. But a lot of people do rent out their second home depending on the time of the year and what the demand is or what events are going on, especially now with internet housing. The second home market is actually
like
changing.
the Airbnb thing.
Everything
and so
that we do right now is changing. We are in the industrial revolution of technology. So what's good today is not going to be good tomorrow. And all these things, as things change, lenders are actually amending their guidelines to accommodate today's lifestyle. That's where I kind of see it.
Second homes also get very close to owner-occupied rates, so it's an attractive combination there, Gordon. You can always call the show 800-516-1220, 800-516-1220. Thank you very much for the email. You can email us, Tony@BayAreaLoanSource.com. A couple other topics today. Applications for refinances spiked 9%, even though rates are staying flat. It's the time of the year, Gordon. I think people are just trying to get something in before the end of the year. They saw the holidays come around. Maybe they're starting to think about getting some cash out for Christmas. Who knows? But what do you think about that?
Well, I read a report online today. They're saying 2017 has been a very profitable year for the average person, average investor. A lot of people have made a lot of money this year for 2017. Conversely, since we came out those tough years, 2011, 12, 13, 14, 15 consecutively. So now the more money people make, people become more comfortable. They want to spend money now. What they call consumer demand is high. Consumer flexibility is feeling good.
Consumer confidence.
Consumer confidence is feeling good. And all these things go into a robust market, a robust environment. And when you see these things, we kind of see it on our side. Applications increase, especially this time of year. I think the applications kind of slow down, but we're seeing a spike in applications because I think we're going to get one more rate increase this year.
Yeah, that's another thing too. So people are trying to anticipate that. Here's another reason. 9 years after what's acknowledged as the start of the housing crisis, about 2.5 million homeowners remained underwater. But the rest have seen their equities increase 11.8% year over year, an average of $14,888 per homeowner as a nationwide aggregate of $870 billion increase. 63% of the people who own a house have a mortgage. That's a lot of equity out there. And when your equity improves, you look at things like consolidating debt, you look at better terms, i.e. rate, on your transaction. So you may not be taking cash out, but you may get a better term. Right now, a refinance of a 30-year fixed, that rate is cheaper than an equity line. Well, I looked in equity. I went to, I so badly want to say the name of this bank. It starts with an M and ends with bank. And I went in there and I looked at their rates, and not only did they not offer it as a 30-year term, it was a 24-month, but they had a 15-year back and a 10-year draw, but their rate was like 6.7. It was prime plus 2, and you can get a 30-year fixed right now for 4.25%. The Fannie Mae's rates are under 4% right now. Freddie Mac, sorry. And why would you get an equity line? Of course, if you don't use the money, right, you're paying interest on money that you don't use. So a lot of people look at it that way. But why would you get an equity line? And not only that, when you pay it back, it's cash out. Then you have that some people pay interest only, and then they have that reset period, and then they're like, oh, what do I do now? And they may not qualify later. So, and then a lot of people just aren't responsible, and they just take money out, and they keep spending it at a higher rate than they could have if they just took it out at the beginning. So that equity's there, Gordon, and that's another reason why refinances, I think, are going to stay strong.
Well, equity lines are an interesting product. We've talked on the show many times before. First of all, it's not a mortgage; it's a consumer loan. So therefore, the terms mortgages and history of mortgages and laws of mortgage does technically not apply to equity lines, even though it's sold to you as a real estate loan. The biggest one of the benefits of a equity line is that they're easy to get into. They're very cheap up front. There's minimum paperwork. I think it's a $200 application fee.
No appraisal on occasion.
Appraisal fee, and a lot of different things that lenders make it very easy to get those things. And a lot of people go out and get them simply because they don't want the money right away. They want to know that they have access to capital, access to cash. I think a product like that, if well managed, can be an asset. But it can also get out of line because the payback period that you're drawing on for the first 10 years traditionally is interest only. So those payments tend to be very, very low on $200,000. You might be looking at $300 or $400 a month debt service payment. You're feeling really good. But at the end of that term, that payment gets reset or recast or reamortized, and normally goes for another 15 years. And that payment can go up 3 times the payment as what it was before, and there are the pitfalls now you start to come in. So we also tell people, always read the fine print, make sure you know what you get into, manage your money. That's what you have to do. You have to manage it like it's a budget, and of course you can make it work for you if it's properly managed and administered.
Yeah, Gordon, we've talked many times about some of the benefits of an equity line and some of the pitfalls. I truly do think an equity line is a great emergency product.
Absolutely.
Where, zero balance, you're not paying any, even if the interest 10%, you're not paying any interest on it. It's an emergency.
Cash reserves.
And you also have to, you talked about setting it up as in advance, you have to really plan and manage this. Are you going to be able to pay that money back in a shorter period of time? Meaning, are you going to be subject to higher rates for a longer period of time with that money that you've borrowed? So equity lines are very interesting. They are heavily pushed. I would be really careful about, send me an email. I'll tell you where the best equity line rates are. If we're not the one giving it to you, I can tell you where the best equity lines are because I've done a lot of research on this. My email is tony@bayarealoansource.com. But I will also, before I give you that information, I'm going to also tell you why I think they're good and why I think they're bad. And hopefully you fall into one of those categories and you make a good decision on that. A
lot of times when customers come to us for equity lines, we recommend taking the maximum cash out first. That way you get a long-term fixed rate on a longer period of time of a low rate, and then taking the equity line to go along with that as supplemental access to money, access to cash. And that's what we do.
A lot of good combinations out there. Equity lines are ARMs. They're true ARMs, unless you get a fixed. But we're going to talk about adjustable rate mortgages and why they're making a comeback. We're going to talk about that when we come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's
and I'm Gordon Hines.
And we'll be right back.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us.
We're here every Thursday, drive time special, I call it, from 6 to 7.
Special drive time. Or drive time special.
Drive time special. People are tuning in their cars right now listening to us.
I think more people actually on their phones, they're looking for podcasts. You can go to our website, get the podcasts, BayAreaLoanSource.com. They're a lot of fun. You can go back, I think, back this whole year, in fact. With that said, we had lots of topics to hit. We kind of left going into break talking about equity lines. And I kind of squeezed out the comment that they are adjustable. A lot of people don't remember or realize that they're getting equity lines tied to prime. Well, people are in ARMs. One of the reasons why ARMs are making a comeback is because they offer a low rate. In some cases, they're 1% lower than a 30-year fixed rate. And you know what, a $600,000-$700,000 loan or higher, you have to. Some of these jumbo rates are fantastic, and you look at the difference. Your payment's like $700 difference. Oh my gosh, that's $8,400 a year, and in 5 years, that's $40,000. So there's some people going that really kind of makes sense to end up with the same balance, Gordon, and pay that much less. A lot of people are thinking it makes sense, but there's also the same people who are having to get an ARM because it's a lower rate with a lower payment, and that helps them qualify. Those are the ones that actually scare me the most, because if you're having trouble, if you need to get an ARM, qualify for a loan with the lower rate, what's going to happen when that 5-year or 7-year loan starts adjusting, and maybe you want to get out of it, and then you've already squeezed your debt ratios, and maybe something's changed. Maybe you have more debt. You're already squeezing it, to the bone right now. So what do you think about, you see the two differences here? Some people are getting it because they want to save money. The other people are getting it because they have to.
Well, that's one of the reasons why in a lot of underwriting guidelines, one of the lenders, they have apprehension when a person has to pay off debt to qualify. So because we know as human beings, we're creatures of habit. If you pay off debt, it's only a matter of time before you start reaccumulating debt. It's very hard to live debt-free in a credit society. So when we pay off debt to qualify, if you barely qualify because you have to pay off debt, when you start to reaccumulate that debt, you're not going to qualify no longer for your mortgage payment. So it's the same kind of a situation when you're qualifying at a low teaser rate, as we call it, as the rates and things go up. Like right now, if you have an adjustable rate, anything, you're seeing for the last 12 months, you'll start to seeing those payments slightly start to increase because
if you're in that adjustable period already,
has been increasing their rates. So as time go on, as rate go up, what you're banking on, of course, as time go on, you're going to make more, you'll be making more money, and you're figuring that the increase in income can help offset the increase in debt. That's what a lot of people bank on, I think, when they look at those just barely getting in.
Yeah, and well, you look at somebody who got let's say a 7-year ARM 7 years ago, and they were originally given some sort of estimate on what they were looking forward to 7 years from now. The LIBOR is up over 1 point since in the last few years. So, and that's a very, very, the 1 year LIBOR is London Interbank Offer Rate, and that's the index that a lot of these ARMs use, and that's up. And when that resets, and you probably didn't have interest only because those started fading out, 5 years ago. But you still have that higher rate that's going to hit you and that higher payment. The one thing that I like about ARMs, and I think a lot of people, one of the reasons why I think we're seeing more ARMs is I think people are just understand the risk a little bit better. And number two, we don't have those risky elements to it. The interest only, they're still out there on what they call non-qualified mortgages or portfolio mortgages. But for the standard conventional conforming loans, those risky elements are gone. The neg-am part, the interest-only part. So it's a little bit more solid kind of a loan where all you're worried about is that one risk, and that's the rate going up. But the people who actually save the money, okay, my 30-year fixed is $2,000 a month. My 7-year ARM is $1,700 a month. Okay. So I'm going to take that extra $300 and I'm going to put it away. I'm going to put it into some sort of account that maybe earns some interest. Maybe it's a stock, but they're not going out spending it on vacations or a car payment or things like that. And then when the time comes, 84 months later, the 85th month, everything starts to adjust, and they're like, okay, I've saved some money. Maybe I refinance and I use some of that money, or maybe I just use that to supplement my payment for the next so-and-so years. So if you actually added up a 7-year ARM, the difference I added, it's like 11 years. If the rate went up 2 points at the first adjustment, you could still use that money that you saved for 11 years. So there's the risk. Do you get a 30-year for 11 years and pay the higher amount, or do you get a 7-year and save the money and then refinance it if rates are higher? And maybe, so the thing is if you go going to refinance anyways, the rates for ARMs are always lower than the 30-year fixed. So you may get into a cycle of we're in ARMs. When you get in an ARM, doesn't necessarily mean you owe more money down the road. It just means that you may have to refi.
Well, I think all those theories work great, but the consumer has to have the discipline to apply those theories, apply those savings that they're actually having. The customer has to actually do it. And a lot of times it's discipline. A lot of times people start out in one direction, but as time go on, the mechanics of the transaction change. Mechanics of life changes. The payment demands change. Something you didn't plan for change. So that $300 you were planning on socking away, now you have to use it for some external cost that you didn't plan on. We'll be back. Thank you for tuning in. We'll be right back after this message.
This is Money 2.0 on AM 1220 KDOW.
I'm going back to my roots another day, another door, another high, another low.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
So as promised, we have several things we want to talk about. One of them, new mortgage loan limits from Fannie Mae last week. The two GSEs announced they would raise their conforming limits for the second time in a year. There's two limits you want to be paying attention to. One's the regular conforming limit. That went from $424 all the way to $453,000. Yay. And then the high balance conforming, which the rate's a little bit higher. There's some other restrictions like credit score and cash out and things like that, but you're still conforming. $679,650, and these are available right away. And we just heard today from HUD.
Oh, yeah. The HUD announced its new FHA loan limits for 2018,
going to match it. Yep.
And it looks like they're going to follow suit along the Fannie Mae and Freddie Mac. $453,100 for conforming and
$679,650.
For,
so that means
for
3.5% down on an FHA loan. You're somewhere around 700 some thousand. So 3.5% down, and you're getting a $710,000, something like that. Purchase, which is fantastic, and then that even gets better if it's a duplex, triplex, fourplex. What was the fourplex? It's like 1.3 or something like that.
$1,316,000. Could you imagine buying a fourplex with $1,316,000
with 3.5% down?
3.5%
Or if you use the conforming limit, you can use 10% down or 20% down, and this is why these are very powerful in a place like the Bay Area. Jumbos are obviously anything over that, and there's a reason why you want to stay conforming. And here's some of the reasons. Lower credit score qualifications. We all know that. Jumbos require pretty hefty credit scores, and if you're at the bottom, you're going to get really dinged on what they call pricing. Higher debt ratios are allowed. Fannie Mae and Freddie Mac loans use what they call DU and LP. Those are automated decisions, and those Gordon have really loosened up. I mean, you can get property inspection waivers, which is an appraisal waiver. It's just another way of saying it. A great tool if you can get on owner occupied. Higher loan to value limits for cash out and for regular loans. Shorter wait periods for credit events like foreclosures, short sales, bankruptcies, and modifications. A lot of people don't know this. They get in a modification, and they're subject to some of those wait periods, Gordon. They didn't know. It's something they didn't tell you about. Hey, I'm going to get a short sale. Fantastic. Oh, by the way, your credit screwed up for 4 years. I'm going to get a foreclosure. Oh, my credit screwed up for 7 years. You can't come back to us. Okay, so they're going to give us this modification or this foreclosure or whatever. And then 70, they say they don't tell you. Anyways, lower amount of asset reserves. That's something that we see a lot where somebody's looking at a jumbo, but they don't have the asset reserves. And some of these places like 12 months, 18 months, Gordon.
You know, I had a customer this week that asked me this question. I had to think about it for a minute. He asked me, well, Gordon, why the tiered? Why, we were talking about the increased loan limits. He said, why don't they just do the loan limits forget the 453, 100, and go to 679? The rate's not that different between the two. And I said, well, you know, it's not necessarily the rate. The guidelines are a lot different. The reserve requirements, the event happening wait times are different. That's the biggest difference between the two. It's not necessarily the rate between the conforming limit of 453, 100.
It's a huge difference for jumbo.
It's the actual requirements of that loan, what you can and can't do. The minimum credit scores go up. So a lot of different things go into those two different products, even though they're very, very similar, just based on dollar amounts.
Jumbos rarely allow equity lines over 80%, where the Fannie Mae and Freddie Mac loan limits will. Standard auto approvals, we talked about that. Limited documentation, where you say limited documentation to somebody with a lender with jumbo, and they're going to slap you in the face. And then the cash out, they're aggressive on cash out guidelines. I think you can go max cash out in the conforming limits, but the jumbos, they're going to limit you in some respects. And we talked about speaking of jumbo, we actually have that. A lot of people out there, first-time home buyers, have been stuck not being able to get a mortgage over $1 million. We have the lender that does it up to 1.5, if it means anything. I know there's a lot of people that are first-time home buyers looking for loans over $1 million and they're getting declined. We have them up to 1.5.
And you say, who are those people? Believe it or not, I had an application the other day. Unfortunately, they got bid out on their contract. It was a young couple. Both just got out of intern school, looking to buy a $2 million house in the city.
They got the down payment, they got the income, but nobody will lend it to them.
And they were first-time buyers.
We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. Call the show, 800-516-1220.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
As always, thank you for joining us today. You can always call the show 800-516-1220. A little bit of news out there. Mortgage education is not growing in the United States, according to freeandclear.com. It's a mortgage education website saying that Americans lack the basic knowledge about getting a mortgage. One part of the survey found that 20% of borrowers think it's impossible to buy a home with a down payment of less than 5%. Yet FHA, 3.5%. VA loans, 0 down payment. Conventional loans are in the conforming limit, which is now $453,000, requires 3% down. It's definitely one of the reasons we do the show, Gordon. And quite honestly, it's not just buyers; it's refinancers as well. That they have these misconceptions.
Well, that's interesting because I would challenge that story because we talked about this on the show before. I find that today when I'm dealing with customers, they're a lot more informed, they're a lot more knowledgeable than they were prior to the bust in 2007, 2008. A lot of customers understand amortization, they understand rate locks, they understand pricing, they understand adjustment. So I see it a little bit different.
Yeah, I do too. I think we have a well-educated buyer pool out there and owner pool. And I think some people have short-term memory loss when it comes to how they did their mortgage the last time. In fact, one of the categories that's they surveyed was what they call the intimidation factor. And they said that there's about 18% of applicants drop out because of the complexity and intimidation of the process. That's a big percentage, which means that there's probably some people out there that didn't call you, Gordon. And because of the nature of the way you get business, you're getting educated buyers. The survey also found that 24% of borrowers researched online at various sources. Meanwhile, only 2% accessed mortgage education websites. Only 41% shopped for home loans with multiple sources. That means that 59% did not. They're getting a referral from their realtor or they're using their own bank. But they did guess low on how much they think they should spend of their income of 34%, when indeed you can actually go up to 43%. And in some cases, Gordon, you can go higher. So the intimidation factor is something that I hope changes more and more often. I hope that 18% goes lower because it's actually gotten a lot easier to get a mortgage. There's the low documentation lenders that we use. They do their own verifications of income, and I think it's just there's still some people out there that just don't know how to talk mortgagees, and you get people who are you get realtors who talk about mortgages instead of referring it to a good loan agent. You get companies that have these in-house mortgage guys, and they're picking and choosing which ones they want to work with, and they aren't really. They're either too busy or they just don't care. So it's still hit and miss out there, isn't it?
Well, I think technology plays a big part in education in today's world. I mean, especially with the young millennials, as we always say, these guys always have their phone. There's so much information they have access to as far as rates are concerned, what's going on in the marketplace. I'm dealing with a client right now that's shopping for homes, and they're actually shopping for homes on their own. And when they come across something they want, they then call their realtor. So they no longer have to rely on the realtor, sending them listings to look at. I mean, these guys are on their phones all day long looking at. They send it to me. Hey, Gordon, what do you think of this property? Can I qualify? And it's kind of interesting dynamic going on, that whole qualifying transaction that was way different than before. They're doing virtual tours. They're not even going out and seeing these houses. They're making offers based upon what they see.
The last purchase we did was sight unseen.
So a lot of times this technology has made these things different in our marketplace. Once again, the market's changing and we got to change with it. And I think it's up to our professionals to be prepared and be as educated as our borrowers. And that's where we come in. That's what we do. We focus on the education. We focus on what's going on in the marketplace. And that's why we do the show every week, to keep you informed of what's happening. And we hope that you tune in. We hope that we are of service. If you like what we say, call us and say, hey, we like what you say. If you don't like what we say, call us and say you don't like what we say. How can we improve? We can only get better. That's what we're trying to do here.
Some of the reason, one of the reasons of the many I don't like people using banks is because they try to rope you in. You may go in there just and say, I need to get a home loan. Well, sir, I think you need to fill this application out. And are you a member here? And I mean, you go through the whole gamut when really they need a friendly hand holding. They need a friend to guide them through whether or not it makes sense or not. We had a call today, a great call from someone in Castro Valley. He has a couple rental properties. He owns his primary free and clear. And I think he just needed a reality check. We may or may not be able to do as long because he's on limited income. He rents out his basement of his house and gets about $600 a month there. He doesn't need a lot of money because his house is free and clear, and he's got these rentals that are generating some income, and you want to take some money out and pay off one of the rentals, but he only saves $150 a month. That doesn't make sense. He goes, well, so the other, I'm like, no, this may not make sense because you have some closing costs, and is it really worth doing it? You're taking money from one house and putting it into another house. Are you going to get the same write-offs? Have you really talked? Sometimes people just need that hand-holding and that friendly voice on the other end. And
Or sometimes they need to be educated.
Or
That's
a reality
exactly
check in some
reality
cases,
check.
too.
They need to be educated. That's what we're here. We know all the ins and outs. Matter of fact, with the client in the office right now, we were just talking about loans, and he just mentioned, hey, Gordon, why not look at redoing my second? And that's something I hadn't thought about. And a lot of times as we talk on the air, we spur different conversations, and we go out and do different things. And that's what we do. Education is very, very important. Access to information. And also we all talk about it's not racist products. The more and more products come in the market, the better we can be at our job that we do here.
It's kind of interesting that you can go get a reverse mortgage, or some FHA loans will require that you actually get counseling. But most loans 90% of the loans out there don't require any kind of counseling. So there's a little bit of hypocrisy as far as what lending should have counseling and what shouldn't, and who's supposed to be educated and who's not. So I don't think that's predatory at all. I think it is class. They're dividing some classes based on age in that case, but. With that said, okay, let's move on with some news. 800-516-1220 if you want to call the show, 800-516-1220. Tony at BayAreaLoanSource.com is the email. Let's see, which way? Home flippers. Home resellers are netting less in the third quarter. Average profit of $66,000. That's down 2.5% from the same period. Are you? Do you have any thought on why we're seeing a little bit less?
Well, the prices have gone up. Actually, there's a home show that I watched, and I was watching a show the other night, and these guys were reselling homes in Las Vegas, and I was listening to the margins that they're predicting they were going to make. And I said, wow, that's a small amount of money for a resale. But of course, the difference in that scenario, this particular show, the host was the wife and she was the agent. The husband was actually the contractor. So he was actually doing majority of work himself with the help of a crew.
Fixer-upper.
His margins didn't need to be the higher margin I have because I can't do the work myself. I have to hire a crew. So his margins can be a lot more tighter than I can. But that's the difference. They can buy houses that have less margins in them, hence, higher prices, higher resale prices, and the margins there can make it where it wouldn't make difference for a guy like me. That's the difference.
I don't think this 2.5% decrease is a big difference. I think there's still a good market out there, especially in Vegas. I was just looking at some stats. Vegas inventory is down 33%. That means if you get your hands on something, who knows? You're going to get
make some money.
You're going to make some good money. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. Call the show 800-516-1220. We'll be right back.
This is Money 2.0 on AM 1220 KDOW.
Come with me now. Come with me now.
Welcome back in. Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Sorry, a little technical difficulty there. Definitely user error. With that said, I look at that report that home flippers are netting less in the third quarter, 2.5% down. Average profit $66,000 per transaction. And Gordon and I were talking off the air about whether or not, let's say I'm from the Bay Area, I've been here for many years, and I'm looking, I got a couple $100,000, or maybe I have the equity that I can pull out, or a home equity line or something. I get my hands on some money, and I look around and I don't see a lot of inventory. I see a lot of high-priced homes, but I'm looking at places like Vegas or Reno or Boise or Utah or Phoenix or so on. And, you're seeing home prices go up. You're also seeing inventory starting to shrink. And you start thinking, and you said that it'd be harder for somebody to buy in an area that they've never, or try to flip, in an area that they've never been to or lived in, and they don't know the community as it would be in their own community. So you'd suggest that they either try or at least accept the fact that it's going to be harder and they may not make as much money.
Well, it's different. I think one of the biggest things in transitioning from one area of the country to another, your mindset is based upon the way it was and not the way it actually is. A lot of times there's nothing like California markets. These markets here that we're in are robust, are diverse. I mean, they can bounce back. I mean, they can change overnight. Some of those markets are so much slower. what you actually see is what it actually is, but you're thinking California when you start looking at some of those particular properties, and the margins and the resales and the appreciation is not quite the same. And one of the reasons why you're seeing the profit margins down is also too it's a lot more competitive. So now instead of you go out to buy a house, you're looking to resell, instead of 2 bidders, there are 10 bidders. So now that 10 bidder could have taken that price up another 10% versus what you would have gotten it from a year ago, because there were only 4 bidders on the property. So now, of course, the margin, the resale price is still the same, but you paid a higher percentage price going in. So, of course, your profit margin is going to suffer based on what you're going in. I always tell people the good deal is not what you sell the property for, it's actually what you paid for it. Your basis comes from what you paid for it, because that's going to determine your margin going in, and then you have your profit margin based on that.
Gordon's done many types of these transactions. He's done where he literally takes something over and slap some paint on it and flip it, and he's tearing things down to the ground. And some of them you keep, some of them you sell, some of you convert to, like you had a 4-unit that you converted 2 into condos and 2 into that you sold, and the other ones you kept as rentals. I mean, there's a lot of creative things you can do. It always helps to start with somebody who's done it in the past. That's what we're here for. We hope that you get an opportunity, if you are looking at this type of strategy into real estate, to talk to professionals. You can always email Gordon at bayarealoansource.com, or you can always call the show, 800-516-1220, or our website, bayarealoansource.com. Some of these stories are going to start hitting more and more and more. Real quick, Gordon, the tax bill will make home prices plunge. In this case, some New Jersey residents think they're going to go down 15 to 20% because of the cap on their what they call SALT, state and local taxes, and the mortgage interest deduction. That's a tough one. I don't even want to talk about that story.
Well, what we're going to do, we're going to get a tax expert to come in before the end of the year and kind of talk about the new tax bill, what they foresee, and then all the plans and the different income brackets and how it's going to affect us. And that's what I'm excited to.
Okay, we'll have that. We'll sign up for our newsletter. We'll tell you when that's coming. You go to bayarealoansource.com. You can sign up for the newsletter. We'll have all of our guests that's upcoming on that newsletter. Quick other story: millennials are taking over real estate, but they're going deeper into debt. So there's a very interesting story about how they compare to the Generation X, with the greatest generation, and the baby boomers. We unfortunately can't get to that today.
This year in history, one of the most biggest days in history, December 7th, 1941, Pearl Harbor. Changed the culture and the landscape of America versus war. 1941.
Thanks for being with us.
Pearl Harbor.
And Pearl Harbor. We'll come back next week here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. You can always visit our website, bayarealoansource.com.
Are you a writer?